You're standing at the counter of an auto shop, and the guy slides the printout across to you. 600 and change. You already know what you're going to say. Go ahead and run the card. And you already know, somewhere behind your eyes, what that card is going to charge you for the privilege. Here's the thing about that moment. The feeling isn't really fear. It's the feeling of having no leverage, of being handed one option and calling it a decision. Now, everybody tells you that $10,000 in the bank buys you peace of mind, and they picture it like this. You stop lying awake. You stop doing math at 3 in the morning. That's real. I'm not going to pretend it isn't. But it's also not something you can check. You can't open your banking app and see peace of mind sitting there as a line item. So here's what I actually think changes at $10,000, and I think it's bigger than the feeling. It isn't how you feel about money. It's what money costs you. You've been paying a surcharge your entire adult life on ordinary things, and nobody ever itemized it for you. So in the next few minutes, I'm going to do 3 things. 1, I'm going to itemize that surcharge. Actual dollars, actual percentages, line by line. 2, I'm going to show you roughly where it stops and where that number actually comes from, because it isn't where you think. And 3, I'm going to show you the brand new cost that switches on the day it does, which almost nobody warns you about. Every number in this video comes from the Federal Reserve, the Consumer Financial Protection Bureau, the FDIC, or a peer-reviewed paper. Nothing here's a vibe. My name is Wes, and I spend way too much time thinking about money. If this ends up being useful, hit subscribe and give it a thumbs up. It genuinely helps. This channel is about getting rich the boring way. No trades, no hype, no secrets. Just the mechanics. So let's start with where people actually are, and I want to do this without making anyone feel stupid. The Federal Reserve asks American adults every year whether they could cover a $400 emergency using cash. 63% say yes. That's most people. That's probably you. 12% say they couldn't pay it by any means at all. But push the question further. Ask about 3 months of expenses, and it flips. 55% have that. So a coin toss. And when you split that by income, the staircase is steep. Under $25,000 a year, 21%. 25 to 50, 39%. 50 to 100, 55%. Above 100,000, 75%. Hold on to that shape, because that staircase is the whole video. It's going to explain something that looks like a character flaw and isn't. And this isn't just a government survey saying it. An independent one asked about a $1,000 emergency and found only 30% would cover it from savings. 24% have no emergency savings at all. None. And 29% carry more credit card debt than they've in emergency savings. Which means for almost a third of people, the emergency already happened. They're just still paying for it. Here's the number that reframed this whole thing for me, though. When that same survey asked what people would actually do about a $1,000 emergency, 33% said they would go into debt for it. 17% would put it on a card and carry it. 12% would borrow from family or friends. 3% would take a personal loan. So the default response to a shock in this country isn't savings, it's debt. Savings is the exception. Which is exactly why the price list I'm about to show you exists at all. Here's my favorite detail. When the Fed asks the largest emergency you could cover from savings, the top bucket they even offer is $5,000 or more. $5,000 or more. 38% of adults are in it, which means $10,000 isn't a modest little goal. It's past where the measuring tape stops. And the typical American household's actual spendable cash, checking and savings together, sits somewhere around $8,000. So why $10,000? Why not $1,000, which is the number you usually hear? I want to be honest with you here because this matters. There's no study that finds a magic break at $10,000. Nobody has measured a cliff at that number. What there is a price list. So let's build the number from the actual American shock menu instead and see where it lands. Item 1. Health insurance isn't the backstop people think because the deductible arrives first. The average deductible for single employer coverage is $1,886. And if you work somewhere small, it's worse. 53% of covered workers at small firms face a deductible of $2,000 or more. Item 2, the one we started with, the car. AAA put the average unexpected repair between $500 and $600. And I want to flag this honestly because that figure is from 2017. Repair costs have gone up since. So treat $500 to $600 as a floor, not a current price. Item 3, losing income. More than 37% of households couldn't cover their expenses for longer than a single month without their main income. And item 4 is the sneaky one. Real financial trouble is usually not one shock. It's income dipping at the same time spending spikes. Researchers who looked at millions of households found families need roughly 6 weeks of take-home pay sitting in liquid savings to absorb that. A middle-income family needs about $5,000 for it. The typical one has about $2,000. So stack them. A deductible, a repair, a stretch without income. 2 of those landing in the same quarter, which is what actually happens to people, that's how you get to $10,000. Not from a study, from arithmetic on the things that actually go wrong. Okay, so that's the target. Now the part I actually wanted to show you, the surcharge. Start at the bank. If your balance is thin and a payment lands before your paycheck does, you get charged for the timing. The median overdraft fee at the big banks still charging, it's $35. $35 to spend your own money 3 days early. And here's the part that proves the point. 79% of all those fees are paid by 9% of people. That 9% pays a median of $380 a year in overdraft fees. Not because they're careless, because they're running close to zero. Nationally, that came to more than $5.8 billion in 1 year. Now the financing surcharge. If you put that $600 repair on a card and carry it, the average rate on accounts actually assessed interest is 22.15%. And then there's my single favorite example in this entire video, because it's the cleanest. 2 people buy the same used car. The buyer with excellent credit finances it at 6.3%. The buyer at the bottom of the credit ladder finances it at 21.77%. Same car, same year, same mileage, different price. And I want to be really clear about what that's done. That isn't a moral judgment about either person. It's a rate sheet. Go 1 rung further down and it stops being a loan at all. The typical payday loan is about $375 with about $55 in fees, which works out to an annualized rate around 400%. And more than 80% of them get rolled over or renewed within 2 weeks. That isn't borrowing, that's a subscription to being short. But here's the beat that made me want to make this video. Because you could look at everything so far and say, fine, that's all interest rates, that's credit. So researchers went and looked at toilet paper. Genuinely. Scanner data, more than 100,000 American families, 7 years. And they found that households without cash on hand systematically can't buy the big pack and can't wait for the sale. So they pay more per roll for identical toilet paper. No interest rate involved, no credit score involved, just a surcharge for not having the cash to buy in bulk. And when those same households got more liquidity, they partially caught up. Which tells you it was never about knowing better. It was about affording to. And there's a newer version of the same surcharge that didn't exist when most money advice was written. Buy now, pay later. Split it into 4 payments, often with no interest at all. Which sounds like the opposite of a surcharge, and that's exactly why it's worth looking at properly. When the Consumer Financial Protection Bureau looked at who actually uses it, the pattern was clear. Buy now, pay later borrowers predominantly have subprime or deep subprime credit. More than 3/5 of them were carrying multiple of these loans at the same time during the year. And they were much more likely to also be revolving on credit cards, to have delinquencies, and to be using payday loans, pawn shops, and overdraft. I want to be fair about what that does and doesn't prove. It doesn't prove the installments caused any of that. It's the same signal as everything else in this video. These products cluster around people without a buffer, because a buffer is precisely what makes them unnecessary. Same mechanism shows up in insurance. A higher deductible means a lower premium. That's just how the product works. But you can't take the high deductible if you couldn't survive the deductible. So you keep the low one and you pay more every single month, forever, to avoid a bill you'll probably never file. And all of this compounds, which is the ugly part. No buffer makes you more likely to fall behind on a payment. Falling behind prices your credit. Priced credit raises the interest on everything in the list I just read you, which makes the buffer harder to build. The research on this is blunt. It's having emergency savings, not your income, that predicts whether you're delinquent. And there's one more finding here that I think is the most important one in this entire video, because it cuts against how we usually talk about this. Researchers compared people who describe themselves as savers against people who say they don't save. And the people who don't save report more difficulty paying their bills. Which sounds obvious. Here's the part that isn't. That gap shows up at every level of income, not just at the bottom, every level. So this isn't simply a story about how much you earn. Two people can bring home the same money and end up on different sides of that price list. And they found something else that stuck with me. 58% of people who have less saved than they think they need say their finances control their lives. Among people who have as much as they need or more, that drops to 22%. Now, I want to be straight about what that's up. That's people describing how they feel, not a measurement of their bank accounts. So it isn't proof of anything on its own. But it does line up with everything else, and it points at the same thing from a different direction. So that's the surcharge. That's what $10,000 actually buys. Not calm, an exit from a price list. But there's a second thing it buys, and this one surprised me, because it isn't about spending at all. It's about what you can say no to. There's a well-known piece of economics research about how long people stay unemployed. And the intuitive read is that if you give someone money, they get comfortable and slow down. The research says that's mostly not what happens. About 60% of the effect is liquidity. It isn't motivation. It's that having cash lets you keep looking. And follow-up work found it doesn't just change when you take a job, it changes which job you take. Now, I want to be careful here because this isn't me telling you to quit anything. That isn't what the research says, and it isn't what I'm saying. The finding is narrower and more useful than that. Cash on hand changes the set of offers you're able to refuse, which is the same thing that happened at the auto shop counter. It was never about the $600. It was about having exactly one option. Okay, so that's the case for getting there. Now the turn, and this is the part almost nobody tells you. Because the day the surcharge stops, your money doesn't become finished. It becomes lazy. The FDIC publishes the national average rate on a savings account. It's 0.38%. The Treasury issues a 4-week bill, which is about as close to risk-free as the system has. That has recently paid around 3.67%. Same $10,000. One version earns you about $38 over a year. The other earns about $367. I'm not telling you to buy anything. I'm not a financial advisor, and this isn't advice. I'm telling you those two numbers exist, and that the gap is roughly $330 a year on the same money. And both of those are safe in the ordinary sense. Bank deposits are insured up to the limit. Treasury bills are backed by the government. So it isn't a risk gap, it's an attention gap. And I should explain what a national average rate actually means, because it's doing a lot of work in that comparison. It's the average across banks, which means plenty of accounts pay less than that 0.38%, and some pay considerably more. The reason the average is so low is that most people's money is sitting in accounts that were opened for convenience, not for the rate, including mine, for years. And the 4-week Treasury bill is just what it sounds like. You lend the government money for about a month and they pay you back with interest. That rate moves, it isn't fixed, and it has been much lower in the past than it's now. So this isn't a permanent $330 gap, which is exactly why I'm not telling you what to do with it. Rates change, your situation is yours, and I'm not the person to advise you. What I'm saying is narrower. Once the surcharge is behind you, the rate on your own cash becomes a thing worth looking at. And for most people, it's a thing they've literally never looked at once. So that's the whole shape of it. Below $10,000, your problem is that money costs you too much. Above it, your problem is that money earns you too little. And I won't oversell what this milestone does because it doesn't fix everything. $10,000 solves the shock problem. It does almost nothing for the 30-year problem. Only about 35% of non-retired adults say their retirement saving is on track. At the bottom of the income range, it's 7%. At the top, it's 59%. That's a different video, and honestly, a different number. 20,000 is where the next thing changes. We'll get there. But let me leave you back where we started. You're at the counter. The guy slides the paper across. It still says 600 and change. You still pay it. That part doesn't change. It was always going to be $600. What changes is that nothing else in your life gets more expensive because of it. Your card doesn't start charging you 22%. Your next car loan doesn't get repriced. You don't buy the small pack this month. That's the whole thing. $10,000 didn't change how you feel about money. It changed what you get charged for it. If that was useful, you know what to do. I'll see you at 20,000.